Hi, my name is Mike Mills, and I represent the legacy team at Equity Concepts. On behalf of our team, thank you for your trust and your friendship. In 1917, Vladimir Lenin wrote, "There are decades where nothing happens, and there are weeks where decades happen." We've seen those kinds of weeks this year and in recent years. 2023 is off to an interesting start. Already this year, we've seen a buy-the-dip rally in tech and other growth sectors after their large sell-off in 2022. Meaning investors stepped in to buy tech and growth at a 30% plus discount in hopes that volatility was over. We don't know that that is completely over. Also this year, the Federal Reserve has continued to increase rates for what will go on record as the fastest rate hike in history. In recent weeks, we've had additional volatility brought on by 3 bank failures that's brought on uncertainty about the economy and the Fed mandate to stamp out inflation at all cost. 2022 had many historic events in addition to the fastest rate hike in history. 2022 was the first time in 150 years that both stocks and bonds finished down over 10%. 2022 is the worst year for bonds since the bond index, the Bloomberg Aggregate Bond Index, came about in 1976. 30-year bonds lost over 30% last year. Also on bonds, I read recently that you'd have to go all the way back to the Napoleonic War era for the second worst showing when long bonds lost 19% in 1803, represented by British long bonds. This came from a study I read by Edward Macquarie, a professor emeritus at Santa Clara University. Why do I mention long duration bonds? Because that's part of what got Silicon Valley Bank in trouble. You see, long bonds tend to be safer investments. However, over the last 12 months, the Federal Reserve has gone on a tremendous rate hike process, raising rates 475 basis points, or 4.75% in less than a year. That does not bode well for long maturity bonds. Historically, long bonds have been a safe haven for banks and institutions to allocate cash. Bond prices react inversely to bond yields, meaning the longer the maturity of the bond, the more negative the impact on the price of the bond from a rate hike. So for example, if a bond has a duration of 5 years and rates go up 1%, the bond will lose approximately 5% of its value. Now, I won't belabor this point, but you can see how bonds lost so much last year. Silicon Valley Bank then had to take tremendous losses and sell these bonds while they were down when depositors wanted their money in a classic bank run, causing the bank's failure. Here's a random but interesting fact regarding banks and borrowing. According to a Washington Post article from March 17, 2023, U.S. banks borrowed over $150 billion from the Fed's discount window during the week ending March 15th, blowing past the previous weekly record of $112 billion during the 2008 financial crisis. We won't spend the day pontificating on what happens with that $150 billion. While these bank failures are indicative of some systemic issues with banks themselves, we do not believe this is anything like the 2008-2009 credit crisis. We believe this will be a problem that affects only an isolated number of banks that have had high exposure to long bonds and a higher than average deposit decrease due to assets leaving to pursue higher interest rates. Possible outcomes from the problems banks are experiencing will be much higher lending standards, lower lending overall, and continued low rates on money markets and bank savings vehicles offered. After all, most banks simply cannot afford to pay higher rates on their deposits without taking on more risk. Federal Reserve President Jay Powell said last August that the Federal Reserve would be willing to raise rates to control inflation, and that could create some pain to households and businesses. Well, I would say we've felt some pain. I would not count us completely out of the woods on rate hikes, but would expect to see a pause at the next meeting. One last area that I want to comment on is M2, or the money supply in circulation. The economy is still absorbing and responding to the 40% surge in the M2 measure of the money supply during COVID. In the words of Brian Westbury at First Trust, think of that enormous surge in the money supply as in installing a furnace built for a 10,000 square foot mansion into a home that's only 2,000 square feet, and then running at full blast. This has gone under the radar by the Fed talk and has been largely ignored by the media as well, but is very important to the economy, inflation, and recession implications. Anyone following M2 would have seen inflation coming. Over $5 trillion in stimulus was issued during COVID, and just recently another $1 trillion during the bank problems. You can see this slide from our friends at First Trust that shows the growth of M2. Now, if you were to overlay the S&P 500 on this chart, you would see that that growth looks similar. Has the market to some degree been inflated by cheap borrowing and the free money of stimulus? We think so. There are implications with too large and too low of an M2 number. Too much M2 and cheap borrowing will continue. When M2 grows faster than the economy like this, we have inflation like we're experiencing now. Too small of an M2 number and not enough growth can lead to decreased productivity and high unemployment. There's a balance here that must be met, but at the current level, it's too high. Regarding M2, we've just started to see this number fall. Businesses are starting to react by announcing layoffs and will likely see profits affected. We'll be watching this number closely. Now, I know you're thinking, is there any good news out there? Absolutely, there's some good news. And as we've said before, we invest for decades, not years. While there was pain felt in the market last year, there were also good investment opportunities. As Warren Buffett has said before, be fearful when others are greedy and greedy when others are fearful. While we don't consider ourselves greedy, we have certainly seen opportunities to invest for the long term and have managed your portfolios accordingly. Speaking of opportunities, let's discuss how we're positioned in our portfolios for public markets and private markets. We continue to lean slightly overweight to cash and short-term bonds, believing it's better to be in these positions than fully exposed to market volatility for the short term. Ultimately, we'll add to long-term high conviction positions when we feel volatility has subsided. For the public markets, in stocks, we're overweight quality companies with a focus on free cash flow. Now, free cash flow shows how much cash a company has on its balance sheets and at its disposal to pay debts, dividends, and is generally a good representation of the profitability of the company. We've also slightly increased our international exposure this year in equities, from an underweight to a neutral weight. Now, some may be wondering, where are we investing in international markets? Well, we're not loading up on China, but we prefer a diversified approach to investing overseas and one that emphasizes the same quality free cash flow focus of U.S. companies that we like. We utilize managers that allow us to get broad-based exposure in areas like Europe and Asia. Managers like First Eagle and Goldman Sachs and MFS. You see, valuations have become more attractive for international investing since the U.S. is coming off of a period of a strong dollar, which has been hard on international markets. In the words of J.P. Morgan recently, when discussing the decreasing value of the dollar, they said, as with anything, winners and losers emerge when the direction of the dollar changes. A key beneficiary should be U.S. dollar-based investors investing overseas. Previous cycles of dollar weakness have been associated with subsequent international equity outperformance versus U.S. equities. We agree and have acted accordingly. Now, for bonds, both tax-free municipals and taxable bonds, we like short to intermediate duration bond investments and will remain here as interest rate risk decreases for longer duration bonds. In our opinion, this could take a while before we see the Fed reverse course on rates. Many of the fixed income managers we invest in have the ability to increase or decrease their duration to best take advantage of rates at any given time. For private markets, we took some profits in our private real estate, private debt, and private equity positions over the last 6 months, but still believe these positions act as good diversifiers in our portfolios and provide lower correlation to the public markets. Our private market alternatives held up extremely well in 2022, most posting positive returns for the year while public markets were down substantially. In our humble opinion, we believe inflation is going to remain higher for the longer than expected and that the Fed will have to raise their current target of 2% inflation. We also believe that rates will stay higher for longer. Remember, we started at 0.25 to 0.5 just a year ago and are currently at 4.75 to 5%. Our country has gone through dozens of rate hiking cycles and lowering cycles throughout the history of investing, and the market's still standing. There's also been thousands of bank failures, and the market is still standing. We only just recently started having all this news broadcast, making it easy to panic and feel we're experiencing it for the first time. There's still talk of a recession this year, which we do not disagree with, but I would remind you that we've been through recessions before as well. We're not overly concerned about a deep recession. Historically, the pain of recession is felt before the recession is declared, and we would argue that we've already seen a lot of this pain. We would not rule out more pain to come, but are not fearful as we continue to focus on investing for decades. Now, none of us has a crystal ball. All of us have feelings and emotions. During periods of economic uncertainty, the media tends to focus on the most negative points and jump to conclusions. Remember that old saying, if it bleeds, it reads? Well, I rather like this quote from Mark Twain in reference to trying to forecast anything. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. We would encourage you to not focus on the volatility of the news, rather focus on your goals and the planning we're working on together. Remember, we're planning and investing for your family's lifetime. Certainly, if you see something questionable in the news, please reach out to us. Please reach out to our team with any questions or concerns that you have. And again, on behalf of the Legacy team, thank you for your trust and your friendship. We hope you have a wonderful spring.